And Galvin, in a minute, we're going to be talking about the Indian budget. So ahead of that, what's your Forex call, or is it going to be a non-event?
Yeah, I think that's, it's kind of a good point because the media reporting and obviously the local news very much concerned about what's going to happen in the Indian budget. I think for us, sitting, a little bit further away in Singapore and for us thinking about things on a macro and market kind of level, I think it's going to be a bit of a non-event because for a couple of reasons. So number one, it's not, this year we're not going into the Indian budget with a credit rating sort of event, right? The ratings outlooks are quite stable. The growth outlook from the credit rating agencies are quite stable as well. And the second point, I think that's kind of a bit of a have your cake and eat it too moment is the fact that the union budget is expected to sort of be consolidating in terms of its deficit, right? So coming in, I think the expectations were previously from about 6.4% deficit in the previous fiscal year to about 5.9% this year. And I think, that's still a huge deficit when you think about the fact that we've moved out of COVID. That being said, in the context, that's still for them a fiscal consolidation, right? And the fact that, they've got one of the hottest growth expectations for the year in the region, 6.5%, down from 7% year on year last year, that's still a pretty good environment. So in a sense, they can still keep spending the government budget. They can still keep pumping sort of the fiscal stimulus into the economy whilst talking about fiscal consolidation. And I think in that respect, the markets are probably not looking towards the Indian budget for any sort of telltale signs on how to trade the rupee today.
Just quickly in terms of the rupee, what's their game here? Because we know they intervene, but keeping it at these levels, what do you think their rationale is behind this? Because you just have to look at, say, for example, the correction that we've seen in the DXY and then the relative stability of the rupee. So what's their intent for doing this? Because a lot of people have a lot of different, rationales about that.
Exactly. I think there are two important rationales that are sort of underlying this from our view, sort of like a flows perspective. The first one is the fact that the RBI has rightly so drawn down a lot of its reserves, right, to help sort of defend the rupee as the DXY was appreciating last year, right? And I think in this context, as peer FX continues to appreciate, as the dollar continues to weaken, that provides the RBI ample opportunity to rebuild some of the reserves, right? So they're using their reserves when it's a rainy day, and they're reaccumulating their reserves when the sun's out. The second point, I think, is that the fact that we did see last year a widening of the trade deficit, right? And that's expected as the Indian economy recovers. But that being said, what we saw last year in the trade-weighted rupee was that didn't really move by as much as expected. So if you sort of look at the models and you do a bit of tinkering, what the model is actually suggesting is that you need a corresponding depreciation in the trade-weighted basket to bring everything sort of back into line, back into equilibrium, right, in that sort of technical speak. And so I think part of that also is helping to bring that sort of depreciation into focus as the peers appreciate and the rupee stays put. So you get a sort of relative depreciation, and that sort of helps bring sort of some of the external indicators back into balance as well.